don't have enough room on my screen for all of this. Alright. What is going on here? It'll work for me. Okay, so you have that. Set that value with 17,990. There we go. So we have these values, yearly cash flows, and now we need to figure out a rate to discount these. So the NPV, if you notice, the NPV formula. What is the NPV formula? NPV, and what are the two arguments that you put into it? Well, what do we need to figure out the NPV? Come on, you guys have been paying attention. Somebody who isn't already a PM. What do you need to calculate the NPV?
Well, you need to calculate the initial cash outflow, which is the investment, and then you need to calculate the present value of all the cash flow.
Right. Right. Well, in this case, we don't have an initial investment. We're just trying to figure out what the value of all the cash flows is. And then we'll see that split between the companies, or split between the shareholders of the company. All right, so Dirk, what's the other argument NPV needs?
Interest rates.
Yeah, good. All right. So NPV, yeah, somebody said that up there. So NPV, we need the rate, right? It says we need the rate. So
how we're doing.
Okay. So what discount rate are we using? Basically, we're using CAPM, right? So what's the first thing we need for CAPM?
Beta.
Someone want to look up the risk-free rate so I don't have to?
For what year?
3.5? Okay. Okay, so we know the treasury rate.
3.5.
So let's say it's risk-free. Risk-free plus the beta times the market risk premium. As well. Okay. So that is our RA. Sorry. Okay.
Yeah.
So here's the formula again. The return on asset.
Can I ask a question?
Yes, question.
Why are we using a long-term treasury rate when we're trying to figure out whether or not these are advantageous investments as opposed to simply holding cash, which is a very, very short-term investment and would yield something much more in line with the short-term treasury?
Well, because that's a yearly rate as quoted as the treasury. And so, well, the treasury's quoted as a yearly rate, and we're expecting these investments to not be short-term. WUSIF invests with a 5-year outlook, right? Or 3 to 5 year outlook is what we say. We use the 10-year treasury rate just because that's how I've learned how to do it. If you want to do something else, you can. You just have to justify it.
Well, because you're looking at your cost of capital, which is it has to yield at least this, because you can just buy a 10-year rate and get 3% each year.
Yeah.
So it has to justify at least 3%.
So the treasury rate is quoted as a yearly rate. The reason we use 10 years is because that's close to the duration that we're expecting our investment to be. So okay, 3.5%. What is beta? Or where did I say you go to find beta? What's the one website I suggested? Yeah, if you want, you can use Yahoo. Let's see what the difference is. If you want, you can calculate your own beta. I think for the last pitch that Helen did, where's Helen? Did you calculate your own beta for that one?
Yeah.
So you can do whatever you want. I think Trevor actually did too. Maybe.
Yes, we did.
Yeah, so if you want, you can calculate your own beta. That's just a regression. Beta can be monthly, weekly, or where is this stuff?
Key statistics.
All right. 0.95 according to Yahoo. MSFT beta, let's see. This might be horribly different. 0.92, that's not bad. Okay. Let's see 0.92. Considering they give me a graph of what it looks like, I'll trust them more. And what's the market risk premium? Yeah, what is that? 6. What did I say? 6? I said 5.5. Let's use 5.5. All right. So the rate finally then is what? What should I be adding?
3.5 plus that times that.
Yeah. So that's finally our discount rate. That means that the stock needs to give me at least 8.56% a year to justify having the same return as, or the same return given the same risk as other stocks. So basically, I can take my money and put it into another asset just as risky and get this return. So Microsoft better give me at least this much return. Question? Okay. And then NPV, what do I do? Rate and capital. So basically, no, and I need perpetuity, right? I need to go into terminal value. Well, okay, instead of doing cash flows, let's say they make that much money forever, all right? So then, how do you do this? Anybody know? As a perpetuity, treat it like a perpetuity.
Divided by the
Yeah.
discount rate.
Yeah, this is easy. If you want to take, like, if I were to give you $100 forever, what would you pay for it?
100 divided by
Yeah, 100 divided by whatever you can get by putting it in the bank, or at least the same risk level. So you would take this divided by that into perpetuity. That means that there's that much money into perpetuity of Microsoft. Microsoft will give you that much money in terms of today's value into perpetuity. And that number gets divided amongst the shareholders.
Sorry, where'd you get the 8.56 from again?
That is CAPM. That was what I just talked about. So it's our risk-free rate, right? 3.5%. This is what I could do by just putting it in treasuries. This is its exposure to the market. And then this is
Premium.
yeah. This is the market premium. How much you should pay as a say what?
Did you get the premium? Is that
Oh, the premium, as I said, on average, historically, has been that. Well, it's a question of whether it's been 6 or 5.5%. I wouldn't go as low as saying it's been 3%, or it's not higher than 6% certainly. So on average, the market has yielded 12% returns, and treasuries have yielded on average 10% for the market, 4% for the treasuries, and so the difference between them is 6-ish. So I'm going to use 5.5 because I'm pessimistic about the world, and I think other analysts are too. And so basically, Microsoft is going to give you that much cash flow in perpetuity.
Does anyone ever use like a short-term like average to calculate that premium?
Say what?
Like if you look at what the return has been over like the last year, it's obviously different. Does anyone ever actually
What
do
the
that?
return has been over the last year.
Yeah,
For what rate?
For the market rate.
For the market risk
It's been a
premium?
lot higher.
Well, the thing is, you have to be thinking about it this way. This is the thing. The rate will be determined by what you can put it into other investments that generate the same value, right? So, I can take this money, I can put it into the stock, and it has to generate at least that to justify its risk. Or I could take this money and put it into a different stock with that same rate to justify its risk. So this is putting them all on the same level, and you can see what the rates are. Now the thing is, it'll be depending on what duration you want to use, or how long you want to invest for. But the thing is, you also have to figure in all the prices that are currently on the stock market today. Somebody has probably gone through and done a DCF, and analysts are using their expectations of what it should be. So in terms of the efficient market hypothesis and what stocks are today, they're reflecting the rates that analysts are using. And so that's why I'm saying 5.5% on average. I think would probably be a good estimate of what analysts are using. Yeah, but for example, when you're doing the growth rate of the stock, so let's say these cash flows are going to grow in perpetuity. Let's say next year they're not going to generate that much, but they're going to generate more because companies on average grow. That is something that you should really think about when you put in, because there's a difference between 3% and 2%, and that'll affect your market value pretty easily. Okay, and then of course this needs to be distributed on the shareholders. I have this is my DCF for CBI last year. Right now it's way more than $28. It's $38 actually. So we made a lot of money. Yeah. Okay. Basically, I was using analyst estimates of what the revenues are going to be. Finally calculated it down to the cash flows. This is saying in perpetuity they're going to generate that much more. You add that into the cash flow for the 5th year, and you take the NPV of it, and you take that at the WACC. But today I taught you how to calculate this part, because stocks don't only have equity, they don't only have stock, right? Companies don't only have stock, they also have debt, and they also pay down their company bonds. So you have to consider that rate too when you're considering the overall cash flows of a company and their net present value. And WACC will be a different lecture. It'll be very brief probably. Yeah, WACC, and so you average basically,